Every business owner starts with a vision. You find the perfect location, build out the storefront, and open the doors. But without consistent capital, that momentum can abruptly stop and those lights flicker out. Small businesses need capital to survive gaps in cash flow. When traditional banks say no, owners turn to the alternative funding market. It is an industry that processed up to $32.9 billion globally in recent years, with the U.S. market accounting for roughly $22 billion. But unlike traditional banking, this space operates in a near-total regulatory vacuum. This animated chart displays total defaults in merchant cash advances, where a company purchases your future sales receipts instead of issuing a standard loan. Watch how defaults surged 59% from 2023 to 2024, reaching $2.22 billion. The fallout has caught the attention of state regulators. New York Attorney General Letitia James secured a $1.065 billion settlement against Yellowstone Capital. The network charged interest rates up to 820% per year, victimizing over 18,000 small businesses. Federal regulators are stepping in. The Federal Trade Commission enforces consumer protection and civil antitrust law. They secured a $48.28 million judgment against Seek Capital for a credit card stacking scheme that systematically ruined borrower credit profiles. Federal bankruptcy courts are processing hundreds of filings, specifically citing this type of alternative debt. In 2024 alone, over 230 federal bankruptcy filings disclosed merchant cash advance debt, with distressed businesses commonly carrying 3 to 7 active advances at once. A wrong move in this ecosystem guarantees mathematically engineered ruin. Between predatory repayment structures and high-pressure tactics, the model is designed to extract capital until the business can no longer function. To navigate this market, you have to recognize the 5 archetypes operating within it. The first is the MCA trap shop. Instead of quoting a transparent annual percentage rate, these shops use a specific multiplier called a factor rate to bypass state usury laws. This visualization maps out how a factor rate converts into an annualized APR. A 1.3 factor rate means you repay $1.30 for every dollar borrowed. When you compress that fixed repayment into a 60 or 90-day daily payment schedule, the actual cost of capital expands well past 100%, sometimes exceeding 800%. Many of these contracts also contain a confession of judgment, a legal clause allowing a lender to obtain a court judgment against a borrower without a trial or any opportunity to mount a defense. Lenders have historically weaponized court systems to instantly freeze and drain business bank accounts. The second archetype is the McFunding shop. These act as high-volume clearinghouses. They operate on a back-end success fee model, meaning they only get paid a percentage of the total credit you are approved for. Because their priority is maximizing that 10 to 20% fee, they often take a single borrower's profile and blindly blast it out to 12 or more credit card issuers simultaneously, racking up hard inquiries. This line graph illustrates official data from FICO, the analytics software company that calculates consumer credit scores. Both the MCA and McFunding models rely on structures that extract maximum upfront capital. They prioritize the broker's immediate commission over the business's long-term survival. The third archetype relies entirely on marketing. These are the copy and paste funnel buyers who flood social media with identical cookie-cutter advertisements promising easy business credit. They operate in the snapshot economy. A snapshot is a fully pre-built software configuration that anyone can buy for around $297. It comes preloaded with landing pages, automated email sequences, and fake client testimonials, allowing someone with zero finance background to instantly pose as a financial expert. Then there are the gurus. This fourth archetype isn't actually selling a funding strategy to business owners. They are selling an overpriced course on how to become a funding advisor, recruiting inexperienced people into a business opportunity rather than securing capital. Finally, there are the high-pressure transactional shops. These operations use extreme urgency tactics to extract large upfront fees, and they will frequently coach clients to fabricate their revenue numbers or misrepresent their time in business to secure approvals. Inflating numbers on a bank application constitutes bank fraud under 18 U.S.C. Section 1014. This is a federal crime that carries penalties of up to $1 million in fines and 30 years in prison. Across all 5 of these archetypes, the fatal flaw remains the same. They stack thousands of dollars in debt onto a business owner, but provide absolutely no exit plan for when the introductory 0% interest rates inevitably expire and jump to 25%. Successful capital strategy requires prioritizing long-term bankability over immediate speed. This means structuring your business so Tier 1 financial institutions view you as a priority client based on your corporate profile. Consider Marcus, a business owner who spent 5 months applying for capital. He went through 3 different alternative funding companies, resulting in consecutive rejections and a desk covered in denial letters. This digital checklist illustrates a 47-point diagnostic scan of a corporate credit profile. When run on Marcus's business, it found the true problem in just 30 seconds. His business address at a major credit bureau was showing an outdated 2019 P.O. box, triggering automatic algorithm rejections. Once corrected, the automated blocker was removed. Within 2 weeks, Marcus secured a $120,000 capital approval. That is the architectural process of bankability. It requires fixing corporate compliance first, sequencing credit applications strategically so bureaus aren't overwhelmed, and building relationships through targeted deposits at Tier 1 banks to warm up internal algorithmic scores. It also requires an absolute definitive exit strategy. For example, planning exactly how you will roll your expiring 0% credit card balances into a long-term small business administration loan at much lower institutional rates. True capital optimization always protects your business. It takes the guesswork out of lending by aligning the automated approval algorithms of major banks directly with your long-term growth targets. To see exactly how this process works, read the 12-step Bankable Blueprint guide located directly below this video. Then book a free diagnostic strategy session with our team to uncover your true funding potential.